Hi, welcome back to my channel. Hannah here. I hope you're doing well. So today we're going to look at the general features still under IAS 1. So the general features set out a number of general rules which relate to the presentation of financial statements, and many of these rules are clearly upon principles established under the conceptual framework. So basically, we are going to look at a few rules and principles we need to follow as we prepare our financial statements. So we have main areas dealt with under this part of IAS 1 or under the general features, and these include fair presentation and compliance with international standards, the fair presentation and compliance with financial standards. So this calls for fair this requires the entities effects of transaction and other events to be faithfully presented in accordance with the definitions. In accordance with the definitions and recognition criteria for assets, liabilities, incomes, and expenses set out in the conceptual framework. What do they mean by this? As you're preparing your financial statements, they should first of all be faithfully represented, and they should be in accordance with the definitions and recognition criteria for assets, liabilities, incomes, and expenses as set out in the conceptual framework. We have covered the conceptual framework in financial accounting, and you very well know that the various definitions for these, the assets, the liabilities, you know that an asset is a present economic resource controlled by the entity as a result of past events. So if you know the definition of an asset, before you go ahead to classify something as an asset, you should look at its definition and then the recognition criteria to see whether that item actually fits to be an asset. That is what they basically mean for this before you go ahead to add it into a certain class of transaction. So it needs to be in accordance with the definitions and recognition criteria for assets, liabilities, incomes, and expenses as set out in the conceptual framework. We shall go ahead to look at the going concern and accrual basis. This is area number 2, and you need to prepare your financial statements as following the going concern and the accrual basis. Accrual basis, that means you're going to record transactions as they happen and not as when you receive cash, except for the cash flows, which will also operate on a cash basis. And then we have materiality and aggregation. So what is materiality? An item is considered to be material if the omission of this item or the misstatement of this item can actually influence the user's decision. In case if, for example, if somebody records a different figure of the assets, can this influence your decision as a user if you read a different figure? If the assets are, for example, if the cash balance was overstated, will it influence your decision? So if it can, that means this misstatement was actually material, and if it does not, then it is an immaterial item. So immaterial items can actually be aggregated and then they will become material items. So we look at materiality and aggregation. We shall have then offsetting. This is the next area, offsetting. Offsetting, for example, contra entries having double entry. So assets and liabilities cannot be offset unless it is permitted by the standards. If it is not permitted by the standards, then you cannot offset. In general, actually, assets and liabilities should be reported separately in the statement of financial position and should not be offset against one another. For example, if you have contra entries in our cash book, you normally have bank and cash the other side, those contra entries. So that is offsetting when you're having two items balancing off each other. But in general, assets and liabilities should be reported separately in the statement of financial position, as well as the statement for the statement of the comprehensive incomes. The incomes and expenses should also be written separately, and they should not be offset against each other unless it is permitted by a certain standard. If there is a standard that actually permits it, then you can go ahead and offset it. So we are going to look at the next, which being frequency of reporting. So frequency of reporting, how often should you actually carry out this? So how often should you report? Financial statements should normally be presented at least annually. So it should be presented at least annually. If an entity changes its accounting date and so presents a set of financial statements for a period which is longer or shorter than 1 year, then the entity should disclose, first of all, the reason for using a different period, for using a period that is longer or shorter than 1 year. And they should also disclose the fact that the comparative amounts given for the previous period are not directly comparable with those given for the current period. That is if they change their accounting date to a period that is longer or shorter than 1 year. So the frequency of reporting is a period of 12 months or at the end of every year, so literally annually. And then we have comparative information. In general, IAS 1 requires that entities should present comparative information in respect of the previous period for all amounts reported in the financial statements. This is the least, the minimum. So they should at least present comparative information in respect of the previous period for all amounts reported in the financial statements. Comparatives should also be given for narrative information if this would be relevant to an understanding of the current period's financial statements. The other thing is consistency of production. This is consistency of presentation. Consistency of presentation. So consistency of presentation, in order to maintain comparability, the way in which items are presented and classified should be in the financial statement should generally be consistent from one accounting period to the next. So if you do not apply this rule, if you're not consistent with your financial, this rule may not apply. You may not necessarily be consistent with the way you present your financial statements if it is apparent that a different presentation or classification would be more appropriate following either a significant change in the nature of the entity's operations or a review of its financial statements, and B, if a different presentation or classification is required by an international standard. So those are the general features as stated in IAS 1. Don't forget to subscribe and like the video.